whole life insurance is a scam.
If you look at track record, we're talking 100, close to 200 years of performance with no American or no whole life policy ever being defaulted on for an American. Never.
I'm down with some of the prepper stuff. I definitely have made provisions for rough times, but I'm not going to plan on my life being just going from here to here for the rest of it.
You have a low probability of dying early when expenses are high. You have a high probability of dying as an older person when expenses are low. Medical bills are not going down, and I don't think that the average experience of an older person right now is that their expenses are low. We deeply understand the product we're selling. You don't need to see a guru. You don't need to take our word for it. Just the idea stands on its merits.
We're actually creating a level of protection against our income potential or our assets, whichever is higher.
And then are we getting out of the military and putting our family's financial future in jeopardy by participating in a scam? Or have we looked into this and there's something here? It's the latter. And so is whole life insurance a scam? That it can't be, because
What's up, Hans?
I am a civilian as of today. Yesterday was my official separation day. So I wasn't quite sure yesterday when we were having a little get together whether I was still in or not. But I know for sure that today I most definitely am free of the sinking ship known as the United States Navy.
Congratulations, man. Thank you for your service.
Yeah, I cannot laugh when I hear that. But when people say that, if only they knew what the last 3 years have been. And my mom made the point, I spent 50% of my life in the Navy. I started ROTC at 18 and I'm 36 now. So it was weird that 18 years of being associated with the Navy just ended. And today feels like a new chapter. It's a weird feeling, but starting fresh, and man, wouldn't change any of how the last 3 years have gone down, because that's how we linked up and are doing this business. I actually feel like I'm serving people, which is ironic because everyone for some reason says thank you for your service without knowing what we do at all. And it's just like a default kind of pleasantry, but I actually feel like we are serving people now.
Yeah. And the best thing is you no longer have to wear a name tag on your ass for people to identify you.
Yeah, exactly. How about you, man? Got the beard going. You had a good weekend?
Yeah, I had a little time off here because I'm still in the reserves, but that'll be shaved this week, and that's probably good because I'm going more and more gray as time goes on. But yeah, I went down to the And Asset Mastermind, man. It was absolutely awesome. Saw some phenomenal speakers: Michael Isom, Garrett Gunderson, Tom Wheelwright, Trent Fortner, Caleb Williams, who hosted it, of course. It was awesome, man. Just being in a room full of people that are completely thinking in a way of abundance it's just uplifting and great, man. And I don't have my notes on me, but so I wish that I could quote it directly. I wrote it down, but Michael Isom said something that was awesome. And he has a phenomenal story. Look him up if you maybe find a recording of it. But he was talking about the balance sheet, and he said that your self-worth should be added to your balance sheet. And it really comes down to you being your number one asset, which we talk about all the time, but it was just such a good phrase, man. It's cool to be there. I learned a lot, got a lot to share, which I still want to process my notes and thoughts on it before I share too much and misquote people. Being in a room full of abundance like that, it's funny sometimes you get talking to other people and you find that there's some abundant thinkers, and we're looking forward. We're seeing what the world's going to do. We're seeing how AI is starting to take over so much, and how's that going to change things. But like one cool thing about this business is we're in the human intelligence business. Like, I don't think AI can really replace what we do. And what that is trying to bring value to other people's lives and trying to have a heart of giving. And it's fascinating to think people see and think that it's just going to destroy humans' place in this world and the way we operate. And man, I see a lot of growth potential in the future. I don't see us going back to the Stone Age. I see probably difficult economic times based on what our government's doing, but I don't think that means that it just means we're going to have to pivot. We're humans. We're image bearers of God, and we figure out how to innovate from there if that does crash. Yeah. It might suck for a little while, but I don't think we're going to go back to living in caves. That's my belief.
Yeah, there's nothing that could happen to the dollar that is going to crumble the walls of your house. Like there might be economic turmoil coming, but if your mindset is to just panic and buy a bunker, and that's by the time this is released, the ebook that I'm in the final stages of formatting right now. It's too short to call it an ebook, but addressing that idea of like, how do you prepare in both, whether the dollar collapses or not? How do you make sure that, and we talk about it with Trent, our mentor, all the time, what could go wrong in your financial strategy that would derail the whole thing? And if you ask that question, most of us could come up with 10 plus things, at least before you implement the strategies that we talk about. Is your strategy stress tested against that collapse situation? And we argue that it would be. And that sort of gets a little bit into the mindset of some of the people we were chatting with this weekend. We're going to run through today a conversation we had on actually the group that we met in. It's a really solid group of military aviators that fought the mandate and won. Winning looks different for each of us. but we all stood up to the military and outlasted them. So really solid group of guys. And we talk about a lot of things in there. And one of the things we talked about was whole life insurance and IBC. And we wanted to use this platform to address some of these comments because we spend so much time answering the same questions. And so this was more of the same concerns, challenges, critiques, et cetera, that we get. And so we thought this was a great way, because if these guys are asking these questions, chances are you might have had some of the same questions. So we'll talk through it today. Why don't you kick us off with where the conversation started, and we'll run through a little bit of it and give our thoughts as we go.
Yeah, and like you said, I kind of want to say, like, these are absolute A plus. These are the people that I want to stand shoulder to shoulder with going forward. So some of them have objections, and some of them to what we do. Some of them just have misunderstandings. But these are some of the brightest, I'll call them actual patriots, that I've ever met. And if they have some of these questions, then a lot of people are going to have these questions. So let's roll with it. And I'm just going to kind of read some of the comments. I'm not going to identify who made them or anything like that, but I'll just read through what some people say, and then we can talk about. I'll give you a chance at first to give some commentary, and I'll say what I think as well. So one person says, not a swipe at anyone, open to discussion, but I can't seem to make the numbers work. And here we're talking about whole life insurance. You're making an investment in today's dollars for inflated away dollars on a policy limit that is based on today's dollars. And so, for example, they say you buy a $500,000 whole life policy, you're damn near paying almost that amount in opportunity costs, if not more, if you factor in inflation for, say, 30 or 40 years. And I'll just pause there, because I think there's a lot we can say just right there.
Yeah, I don't know if we'll even get through two of these comments today, because there's just so much there. Off the bat, you're not making an investment. You are making a savings decision. Whole life insurance is a savings vehicle from which we are able to invest, but the investment is not inherent to the product that we're talking about. And that's it's natural. We're programmed to grow our money. We at Remnant Finance and in the IBC community, we talk about protect, save, grow. That is the correct order of operations. And so by saving in this vehicle and protecting our family in this way, we're knocking out those two in the most efficient manner. And then from there, we can invest, do the grow part. But this is coming from the perspective of grow your money, and then grow your money. And that's the typical model that people are used to. Your mind's going to go right to rate of return, the typical investment way that we are marketed to speak. That's not something that you picked up on your own and that I need to focus solely on rate of return. That's something that's been pumped into your head with $1 billion marketing budget from the financial service industry. First thing, you're making an investment. No, you're not. You're saving your money efficiently. You can choose to invest from there. That's my first thought. What do you got?
Yeah, and that's what I would hit too. And what I would say is that it's really important to make this distinction when it comes to whole life insurance, that is 100% not an investment and is not centered around rate of return. There is an internal rate of return, but even more important to that, the way we use it and the way you said to make investments from it, is what is your external rate of return when we utilize and leverage our policy? And it would be more appropriate to compare whole life insurance to other savings vehicles, like a savings account or a money market account, or maybe even a CD, although it's far superior to all of those because of the control aspect and all the other benefits that we've already talked about in previous episodes. So yeah, I'm with you there. But so we're in 100% agreement. The next thing to address there is that we're making an investment, which we already talked about. So let's just change that and say, okay, so we're saving in today's dollars for inflated away dollars on the death benefit. That could be true if it was a level death benefit. It's important to think that or to realize that we are using mutual companies and they are all participating. That means they pay a dividend. So when we structure these for the infinite banking concept, that dividend is going to buy more insurance forever if we use it, potentially forever, at least for the short term and probably into senior years. And we're also structured, we're buying what's called those paid up additions. That's what give us the greatest cash value growth. So we have an ever increasing death benefit that is going to keep up with inflation, and it's not going to stay. If it starts at $500,000, like his example, it's going to end far above that.
Yeah. And for, of course, illustrations, as we know, are projections they're not actual representation of reality because it's making an assumption. But one very safe assumption we can make is that the companies that we use will continue their 100+ year record of profitability and dividend payment. Again, we're the owners, so we get those dividends. We put those back into the policy. So my death benefit, if I live a full life and I make it to my 80s, on the projections, again, non-guaranteed side, this assumes dividends and profitability from the company, but it's in the order of 7 or 8x my current death benefit that I started at. So we're growing the death benefit we are greatly outpacing whatever inflation could be when you're talking 700-800%, as long as you're putting these dividends into it and putting those to work. But what's remaining constant and is actually becoming a cheaper payment for the rest of your life is you've locked in a fixed premium. So the input actually is what is, you could say, is being eaten away. My 50,000 or my 20,000, whatever your annual premium is, that amount is staying fixed. And so the purchasing power of that amount, you could say, is going down each year. So you need to come up with less purchasing power to have this fixed premium payment, while at the same time, because of dividends, the death benefit is actually increasing. So that point is the point that's trying to be made there. And I'll give it the benefit of the doubt. If you're talking about your standard, you just go to USA and get a whole life policy, and it's going to be a base only. We talked a little bit about PUA and what that is, and that's the paid up edition, how we grow the policy. So benefit of the doubt, if you're only thinking about that kind of policy, yes, indeed, your 500 grand death benefit in the example is going to remain the same. That's not how we do it. And so it's actually the opposite here. The part that you want to grow is going to grow, and the part that you want to remain fixed and is going to be, quote, inflated away is going to remain fixed and get cheaper for you in this inflation projection.
Yeah, your premium is actually inflation advantaged, I would say, because it's just like a mortgage. And those are the two best financial products to be in a high inflationary world: a long-term fixed rate mortgage and life insurance premium payments, because both of those are going to get easier to make as inflation decreases the value of the dollar. Those payments get easier because they never go up. So they're inflation advantaged. And yeah, you mentioned the illustration, and that illustration is just a potential projection that's good for the day it was printed. So it's really about as good as toilet paper, and that it's only good for a one-time use. And it's not good for anything going forward from there. All right, let's move on with that. I think you nailed it. It says, by the time you have cash value to borrow against, actually, and I like that he wrote that, because he said borrow against, and that is such an important distinction that a lot of people get wrong, is they say that we're borrowing from our policy, and we're never borrowing from our policy. We're borrowing from the insurance company against the contractual value of our policy. So it's used as leverage. So your capital never is removed from your policy. So you're never borrowing from it, you're borrowing against it. Kudos to him for getting that right. You're effectively not going to use it unless you messed up, and that's your only line of credit. And the reason he says that is because it takes so long to get cash value. And, if you just go get a stock company's, I don't want to point out any company, but if you go and get a stock company's whole life insurance policy, it might take 10 plus years to have a large amount of cash value that you can start to use. When we structure it with mutual companies for infinite banking, we're going to have access to really anywhere between 50 to 80% of your total premium payment available in cash value right away. So it's going to be very liquid, very accessible, and it's going to have that equity right away. So that's a common misnomer. And I will point out that Dave Ramsey always says that, and that's because he doesn't understand how we structure it and how to use it appropriately.
I think he does. I think he's so dug into that position that even knowing that we structure these for very early usage. For example, I have funded 2 rental properties through my cash value before my first policy anniversary. So that's objectively not a valid critique, but I think he knows that.
Yeah. And yeah, you're right. I think he's disingenuous. And even though he calls us scammers and everything else that you could imagine, but that's another episode. And so the person said, actually, you made this point already, but I just want to point out that they said that if you got a term policy in 30 years, the premium is going to be laughably low and insignificant thanks to the printing and your purchasing power going out the window. And that's actually accurate. He was using that to talk about a cheap term policy that gives you a bigger death benefit. But the misunderstanding was that the death benefit goes up. And even though your whole life insurance premium will be more, it's the same thing's happening. It's still being inflated away by this monetary policy we have. So he actually understood he understood it. I think he was just not thinking clearly on how that works with whole life insurance as well, because he understands the value of the dollar.
That would be the 500,000 death benefit as the example there. That would remain static. And so in that case, yes, you are locking in a death benefit, but not with the whole life. And so I think it was unintentionally making the opposite point. Another thing there, by buying that 500,000 whole life policy, you're damn near paying almost that amount in opportunity costs, if not more, if you factor in inflation for 30, 40 years. And so again, in everything, ask compared to what? So we're saying this whole life policy is not a good use of our dollars. Okay, so compared to what? The likely response is going to be, well, in a stock portfolio that is going to grow higher than the 5 or 6% cash value growth that we're talking about. Okay, so compared to that stock portfolio, you're losing the opportunity cost by buying whole life insurance. But what are you doing with the stock portfolio? If we're talking about compounding interest, you need time in the market, right? If you, on that example of the penny that doubles every day for a month and you have millions of dollars, if you lose the very last day of growth, you lost what, $2.5 million, whatever that amount ends up being. I think it's $5 million by day 30. If you lose one day in the market, that's $2.5 million. If you lose the last 5 days, you don't even have $1 million. right? And so that compound interest is powerful, but there's a long period of required growth there. And so you have to leave that in there in order to get this compared projected amount of money that would be the better use in his example. What is the opportunity cost of money that you can't access for 30 years? That is an access tax. You can't touch that money because you have to leave it in there to grow. You can't periodically pull it out because then you're depleting the principal. We are using our cash value while it's growing without reducing the principal. And so again, it's actually the opposite argument. If your concern is 30 or 40 years of opportunity cost, well, I'm currently cash valuing my whole life policy without reducing the principal. The compared to what in his hypothetical actually would cost you that opportunity cost because you can't touch it because you need to leave it in there to compound.
Yeah, you were talking about that. You mentioned that last day of compounding and the penny a day for a month. And that's another interesting thought. If somebody says like this whole life insurance is an awful place to put your money, I'd rather have in the market where it's going to get a bigger rate of return. True, probably can get a bigger rate of return if that's all we're focused on. So this is going off on a tangent, but every financial advisor recommends, not every one of them, but most of them recommend that you change your portfolio to one that is lower risk at the end. And at what point on that compounding curve do you get the biggest gains? At the top point, at the last point. Yeah. So up until you're like, so let's say death or when that compounding curve is going to end, it's always going to be better to be at risk and face more compounding the higher on the curve you are. And it's interesting to me that they all want to tell you that, well, that's when you should stop taking the possible biggest advantage you have. Whereas if I have this as a buffer asset, if I just have 3 years worth of cash value that I can draw off of if the market's negative, I can take advantage of those monumental gains because I have that money in the market. But they tell you to do the exact opposite, because what happens if you don't have a volatility buffer, something like whole life insurance, to ensure that you won't run out of money because the market went negative if you want to do both? And that's my point here, is that you can do both, but you have to go into a scarcity mode. You have to, because everybody's fears come into play when they've got a pile of money that they can't put at risk and they can't grow. They're either going to run out of money, or they're going to run out of what they're going to give for an inheritance, or they're going to lose it. So they start going into scarcity mode when we don't have to.
That gets to the term expiring. Briefly, this whole comparison is predicated on we have a 30-year term where we could pay a lot less money. In 30 years, 99% of people with term policies outlive them, and you want to outlive it. Nobody wants to claim a term policy because that means you died early. When that 30 years in one day, you now have no coverage. So you're putting the pressure back on all of your retirement assets. And now if you want to get coverage again, because later in life is when people start seriously thinking about leaving something behind, taking care of their children and grandchildren. If you want to leave anything behind now, it's going to be possibly prohibitively expensive or impossible to get insurance. And so this idea that term is cheap, it's cheap because there's such a high likelihood of being 100% cost for you. The day the term expires, it was all cost. You have nothing to show for it.
Less than 2% of term policies ever pay a death benefit for a couple of reasons. People either just don't think it's worth it and they quit, or the term expires because the insurance company knows what they're doing, and the risk was, they were assuming the risk, but it was a low risk for them because you're probably going to live that term. Anyway, so the next point we'll talk about, and I skipped some things, but you could cash flow an investment property for what you're going to pay into a $500,000 whole life policy, and at least the house will keep pace with inflation because it's tangible. And we don't really have to go too hard in this, but I just think it's funny because you already talked about it. You bought 2 cash flowing properties utilizing the leverage of the capital and whole life insurance policy. So you're doing both. And that's the main thing, is like, this isn't an or asset, it's an and asset. So you can have this life insurance and still get that property. And now you have 2 assets growing at the same time. And the thing is that even though he's saying that it is a tangible asset, which is true, it is still a paper-based asset, because you have to rely on somebody else to provide the cash flow. You have to rely on the bank to release it if it's in the walls and equity. And you have to hope that the market doesn't change and the value of the house doesn't go up and down. Whereas in whole life insurance, it's a contractual asset. It has to go up. They tell you exactly what it's guaranteed to do. So yeah, he's right. You could flow all of that money into a property and it's going to probably be a great investment before you. But I think that while he's right, we're more right, because you can do both and be even more, your tide is going to be even higher because you did whole life first.
Yeah. And if you walk off the face of the earth early and you leave your family with a $500,000 house with a $100,000 equity, you've left them $1,000 in an asset that they need to deal with. If you had done the same purchase and acquisition, but through your whole life policy, you leave them the house, but you also leave them many multiples of that in tax-free estate. Something that used to never stand out to me, but now does all the time. We switch our mindset from statement wealth, where it's all numbers on paper that don't have any purchasing power until you actually withdraw them, to contract wealth, where I can know exactly what my minimum wealth will be at a certain year. Is everyone talks about will and it's going to to happen and uses verbiage like that, but you don't get to. We can use verbiage like that because I can say my policy will be here and it will be at least this valuable. I can say will. You don't get to say will. So just reading that sentence, you could cash flow an investment property for what you're going to pay into a $500,000 whole life policy, and the house will keep pace with inflation because it's tangible. That will wouldn't have stood out to me in the past the way it does now. The house will keep pace with inflation. So you're just, okay, what assumptions have to go into that? Of course, you can't say it will because you don't know what the value of the house will be at any point in the future. And you don't know what inflation will be at any point in the future. You don't get to say will. A whole life policy you're buying today will be worth roughly 25 to 50%. That's a nonsense statement. It will. What do you mean it will be? Like, you know what the inflation rate will be? Of course you don't. I know what my policy value will be in the future. But again, you don't get to say. You can speculate, but I'm finding more and more I'm catching that as I read things or tweets online. If you put your money in the market at 8%, you'll be a millionaire by whatever. It's like, maybe you don't get to say 8%. You don't know. You don't get to say any of that. You can speculate again, but you should caveat with that. So anyways, that's something that I can't not notice anymore.
Yeah, I love it. I love it. And the next comment I'm going to go on and read is just makes me laugh. And I'm even going to call this guy out. We'll just call him Bundy. He said, Dave Ramsey is vehemently against it, which is the best endorsement you could hope to find. Could agree more. I love it. That's just made me laugh.
Yeah, because we're past the point of, and to quick caveat, there are many people that desperately need Dave Ramsey's advice. We're working with a guy from this group actually, and I'm going to start working with him, and he needs to get out of debt, and he needs to do Dave Ramsey's baby steps. And I said, you need to do Dave Ramsey's method until you get to zero, at least. And then we'll do the handoff and we can work with you. Now we're going to start working with him now. There's things that he can do to optimize getting out of debt while also setting up systems to put that protection in place. So I'm not just saying do that exactly as prescribed, but philosophically, you need to be in the mindset of getting out of debt at all costs because you have credit card debt and car loans, things that are not helping you at all. And so we need to switch your mindset to cash flowing. But that's not to say that there's no place for that advice. But once you get to zero net worth, once you're out of debt, that idea that you will get this return in the market and you will have this many millions of dollars by this, it's preposterous.
Yeah. And as a matter of fact, you can utilize IBC to get out of debt faster if you have some discretionary income to start the policy. So we'll talk about that too with him. The next thing I thought that was pretty good is show me a financial guru who isn't commissioned that backs this practice. No offense, but the only folks I see screaming from the rooftops that infinite banking is the best thing since sliced bread are those that will financially benefit from my participation. I enjoyed that one. And there's some good points here, and I just want to name a couple. Robert Kiyosaki, Garrett Gunderson, who, along with Michael Isom, who wrote What Would the Rockefellers Do? And there's a new version of that out, which you should definitely check out because people were incorrectly using IULs or using his book to sell IULs. So he rewrote the book to say that is 100% inappropriate. And he would never endorse that method, by the way. Get the new copy. It just came out this past week. So anyway, then there's Garrett and Michael Isom, Ed Slott, who is a kind of relatively famous CPA that used to appear on a lot of mainstream news. Tom Wheelwright, top CPA, Wade Fowle, PhD, who does retirement planning, and even Tony Robbins in his book Money, or what is that? What it's called? Money Mastery. I actually have it right here, but yeah. So Tony Robbins, after he interviewed like the 8 people, include the 8 of the wealthiest wealth managers in the world, came to the conclusion that this was the rich man's Roth IRA because it was better than the Roth and had more benefits. So it is a great question, but it's also an interesting question because this isn't mainstream. It's not conventional planning right now. So just like in 2001, all the doctors like Dr. McCullough, who was screaming against the COVID vaccine, was completely dismissed. All the mainstream pundits were pro-COVID vaccine, pro-COVID-19 vaccine, and anybody that discounted it, whether they had an MD behind their name or not, were silenced and quieted. So if it's not mainstream, you don't hear the voices. So it's almost an impossible question to answer.
Yeah, it's not a great litmus test. And that's what strikes me is, this message resonates really well of severing from Wall Street financial autonomy and basically realizing, like seeing through the financial industry the same way that we saw, like that resonates with a lot of this group, but it's not going to resonate with everyone. But the idea that you need a guru to do it. And what we said was, no, don't take our word for it. Like it's literally a contract. It's a legally binding contract. Just read the contract. And the contract is either enforced by the law or it isn't. And it definitely is. So yeah, don't take a guru's word for it. You don't need to see a guru. You don't need to take our word for it. Just the idea stands on its merits. And so we don't need to debate policy loans like they exist. You can debate, is it better to use it in this case or this case, but that you have the right to use it as is, it's a contract. There's no debate here. So we don't need to get into gurus and whether or not they're commissioned, again, compared to what? compared to your financial advisor, compared to your CPA. Everyone you're talking to in the financial world is commissioned. So that's not really a litmus test that matters because, again, you're talking about where you're going to put your money. You're going to put your money with someone. If you're going to use any person at all, any professional, they're going to be paid. Like, we're capitalists. That's not a bad thing. And so that's not even like a knock, in my opinion, that gurus get commissions from probably like Dave Ramsey's a guru and he gets paid very handsomely for putting people into mutual funds. Okay. But again, does the strategy work? That's the litmus test, not is Dave Ramsey getting paid to put people in mutual funds with the promises of 12% annual returns. Does that strategy work is what you should be looking at. And again, our strategy, you can stress test it. Just read the contract.
And one great thing that I love that I've repeated a few times, it said is, if I can put you into a product that's going to add millions of dollars to you and your family's life, do you care if I make $1 million doing it? I don't know that there's a reasonable objection to that. And we're not going to make anywhere near $1 million on that. A policy is going to add millions, 1 or 2 million to someone's life. But here's my favorite one. And I want to make sure I say around this. That way, when we're gurus, somebody can't clip this. But here's my favorite one. Whole life insurance is a scam. Go ahead. Go.
Yeah, that's, again, it comes back to, this is a contract. Does the contract perform, and is it backed by the US government? The entire economy is predicated on contract law. No companies will send an order for parts to an unknown bank account for people they've never met to receive a shipment of nails or whatever, aircraft parts, anything. Like, contract law being enforced is the foundation of commerce between unrelated, unknown parties. So does contract law apply to the whole life insurance contract? Objectively, yes, there's no other side of that. And so is whole life insurance a scam? That it can't be, because it's, one, if you look at track record, we're talking 100, close to 200 years of performance with no American or no whole life policy ever being defaulted on for an American. Never. But so just with our evidence, anecdotal evidence, and then history of the product, it works as advertised. But even still, we get more simple. It's a contract. You can read the contract yourself. No one who says whole life insurance is a scam is reading through the contract, but it says the words are written on the page. It performs as contractually obligated to do so. That's the basic level of it. And then, are we getting out of the military and putting our family's financial future in jeopardy by participating in a scam? Or have we looked into this and there's something here? It's the latter. Spoiler alert.
We're pretty honest, guys. So that leads me right into my favorite one, and I'm going to read the entire thing. All right. And you've just covered some of it, so we don't have to repeat ourselves, but I'm going to read this whole one without speaking to IBC, but I'll still stand by whole life being a scam. High premiums. A salesman makes commission on your premiums. Think you've covered all that? I've seen numerous retarded people become insured salesmen who know jack shit about finance except to prey on people with good enough salaries and ignorance that buy into the concept. I can't speak to those people. I'm sorry that they have low integrity and they're not very intelligent. That's an industry problem because it is a pretty easy license to get. The money put into it can be invested other places at higher yield. True, and I think we've already covered that.
Can be, sure, but will it? No certainty there. One, we're not investing. Two, there's no certainty there.
And the point I have to consistently make is we can do both. It's not right. One or the other. In terms of the actual, and he put it in quotes, life insurance part.
This is my favorite.
In terms of the actual, quote, life insurance part, if you look at it from an actuarial perspective, you should only need enough to cover your anticipated expenses post-death. As a single dude with no dependents and no debt, the cash under my mattress is enough for a funeral.
Brother, I don't think you know what the word actuarial means, because it has nothing to do with your anticipated expenses post-death. Now, we've spent hundreds and hundreds of hours discussing the common challenges to IBC, to life insurance. We know all of the questions, all the challenges, all the critiques. We've had them ourselves. We've worked through them and came to realize that they did not stand up to scrutiny. What I have never once heard is that from an actuarial perspective, funeral expenses is the only reason for life insurance. That one kind of boggles the mind. There is a coverage for funeral expenses. That is its own type of policy, separate from what we're talking about. That is a thing that you have the option of purchasing, but nothing to do with anything we're talking about. But let's talk about actuarial math.
Before we drive down that, I just want to say that apparently there's not just retarded salesmen, there's also retarded actuaries.
So Brian, what are we actually insuring beyond just funeral expenses? That might be a couple $1,000s, but what are we, by purchasing life insurance, what are we actually insuring here?
We're actually creating a level of protection against, and again, against our income potential or our assets, whichever is higher. So we had a whole entire episode in the past where we talked about human life value. The very simple way is if you took your income and multiplied it by 65 minus your current age. So if you're 35, that's 30 years. So your income times 30 years for a 30 or a 35-year-old, that would tell you what your economic life value is. That's approximately, with some adjustments can be made, but that's approximately what the insurance company will insure as a death benefit. So it's to protect against your future income in the event of that loss. Or if your assets are higher than that number, it's to protect against your assets. So if you have $5 million in asset, but $3 million worth of income, they will protect up to the $5 million in your assets.
And again, we talk about you being your most valuable asset, where the ability of you as a worker to produce reliable income. That's what we are insuring. Again, not at funeral expenses, but an interesting way that I just heard recently from Trent, our mentor again, of a way that you can think about the two phases. You have your accumulation phase before you quote retire, and then your distribution phase after you retire and you're no longer earning your income. In the previous portion, while you're working and earning income, life insurance is protecting that income. If you die early and you still have 20 more working years left, your family is not going to get that income, but with life insurance, they will. So for that phase, you could think of it, you could distill it down very broadly to income replacement during your working years. And then we talk about post-retirement when you're no longer working. The characteristic of what this product is doing for you switches from replacing that income because you're no longer earning it to protecting your assets that are in place. And so Brian hit on it earlier. If your term expires at that point, now you put all the pressure on your pile of money that you grew to do everything. Not only do you have to use that to leave something to your family, but that has to sustain you and your family for an unknown amount of time for as long as you and your wife both live. And so you can think of it income replacement, and then in the second phase, asset protection. Neither of those have anything to do with funeral expenses other than you will pay for the funeral somehow and probably through the proceeds of the policy, but that's not, from an actuarial perspective, that's not at all what you will need or why you're getting this product. That's just a nonsense comparison.
Yeah. And from the actuary perspective, it's just mathematics that focuses on management of risk. So there's actually an entire type of insurance that they do, which is called final expense insurance, which covers that risk of not having the money to pay for a funeral. And it's literally like pennies for a very small amount of money, whatever the average funeral cost they project it's going to be at the year they project you're going to die. So right now, what does it cost? Maybe 10 grand on average for a funeral. So it's extremely inexpensive insurance that only covers the risk of you not having 10 grand. So you're right. You probably have enough under your mattress if you've made a decent living, but it's an incorrect assumption that life insurance in general has anything to do with that final expense in general, except for that, that niche down type of insurance.
I want to hit real quick on the retarded people who become insurance salesmen. And inherent in a free market where we have a government that does licensing requirements, like anyone could get a life insurance license. That is true. The only thing easier might be a real estate license. But again, inherent to any kind of market where there's a disparity between knowledge, you can be taken advantage of. Now, we don't, like, the government could step in and say who can be, like, how these transactions have to go. We don't want that. We want less government. But inherent in that is the fact that disparity of knowledge can lead to disparity of outcome. And yeah, there might be people who don't know anything about insurance, who don't understand what we're trying to do, and who sell a product. That's the marketplace. True. We are not that. We are very well educated on this. We deeply understand the product we're selling, and we are men of integrity who would not do that. But yeah, certainly that is a possibility that someone could be scammed, but it does not speak to the product itself. It doesn't lend any merit to the claim that life insurance is a scam. And if someone is so confident that we are trying to push a bad product and just for the sake of commissions, that's enough for you to not work with us. We could recommend someone that we know personally. We know people that do this very well, that also do this whole life. Nothing in this statement negates the power of the whole life contract.
And on top of that, the same comment, which I decided not to read it because I thought we already covered it, but it also says that unfortunately the whole life salesmen are sharks who prey upon, I forget what kind of people, innocent or ignorant people or something along those lines. I'm already well past that comment. And that's another issue, is that there's no way that a government permission slip has anything to do with the moral character of the person selling something. And so to just assume that everybody selling a certain product is a shark, I don't know. I've gone to a garage and I thought the prices were outlandish, and I've gone to a garage to have my car fixed and everything made sense. So if I just assume that everybody that fixes cars is a shark because somebody out there will take advantage of unsuspecting mechanic mechanically disinclined people, then my car would be consistently broken because there'd be nobody to fix it just because I thought somebody out there was a shark. And guess what? Some mechanics are. And I would agree, some insurance salesmen are sharks. And so are some roofers. And so are some car salesmen. And so are some priests. And so are some pastors. Like, there are a lot of bad people in this world. And that doesn't mean that everybody that does something is bad. And I happen to believe we're decent, moral people. And this is a phenomenal product.
And once again, I'll say it for however many times this episode. Okay, what? Yeah. We're talking about where you're gonna put your dollars. So compared to what? Okay, you've made it clear that the better choice is to get higher yields, so you're investing. So what, Goldman Sachs? Like, you're talking about the character of the person selling life insurance compared to someone on Wall Street that is predating on the fact that you will never ever play by their rules because you don't even understand that there are banker rules separate than the investor rules. But the bankers wrote the rules for both. Okay, if you're talking about where your dollars are going to go and you want to find a pool of commissioned people, because again, everyone you're going to talk to is going to be commissioned. You want to find a pool that is above having any bad apples. I don't know if Wall Street and Goldman Sachs, et cetera, is where you'd want to start your search there. So always ask compared to what, and I think we can pretty well effectively put a ribbon around that one.
Yeah, shortening the next comment because it still discusses some funeral expense stuff, but I think this is good. The need for life insurance over one's life should decline.
I think we would need to have him on the podcast to explain that. I can't really think of, I try to think of the counter argument and make that argument. That's a good staple for debating for anything, is try to make the other person's point, steel man the argument. And I'm trying to imagine how that would make sense. I suppose if we look at, and I brought that distinction between the first half of your working career, you have this income replacement. Now, if you cut it off there and you retire and you believe that your pool of capital that you've invested and grown will be sufficient to do all functions, not only the functions that it's supposed to be doing, but also leaving something for your family, providing for generational wealth, et cetera, leaving a future of abundance for your family. If you assume and believe without any foresight and any actual knowledge of what it's going to be, if you just assume that at that point you can stop with the insurance. And again, that is the basis of buy term and invest the difference. By the time the term falls off, your pile of cash is sufficient. You're self-insured. I guess you could say your need for insurance goes down. But again, the second part of it is asset protection and removing the pressure on that pile of assets.
Yeah. But I think that an important point here that I just thought of as you were speaking from the person who made these comments is that they're single without children. So everything they're looking at is from that lens. And I suppose if I'm 70 years old, I'm single without children, I might think a little bit differently about what I need this life insurance protection for, other than maybe charitable giving. A lot of what we talk about is generational legacy. It's still good for asset protection. It still gives me the opportunity to spend down and everything and have that additional protection. I still see the assets, but I'm trying to say that from that lens, that's where his question comes from. He's not looking at it from the lens of somebody that has to provide for a wife, still wants to leave an inheritance, wants to take care of grandkids, and a lot of the generational things from the way we see it. And so I can understand the question from that perspective. And I agree with you. I'd like to dive into the question a little bit deeper with the commenter to get where they're coming from and see some of the variables that they're thinking about.
And right above that, it gives a little glimpse into where that might be coming from, saying that you're paying a premium to get a payout in case you die. You have a low probability of dying early when expenses are high. You have a high probability of dying as an older person when expenses are low. And I think that gets back to the conventional financial planning idea where you target 70% of your current income to live off in retirement, which again, there's so many unknowns. That strategy is ridiculous to even assign a number. You're talking about, we're concerned about inflation here, but we'll assign 70% of our current income. I make 100 grand right now. I'm going to target 70 grand in retirement, but I'm also concerned about inflation. Like, none of it tracks with proper wise stewardship. But I don't think, if you ask most old people that if their expenses are low, I don't think that's the case. I don't want to lower my expenses by obligation if I choose to, maybe, but like, medical bills are not going down. And I don't think that the average experience of an older person right now is that their expenses are low, especially when medical bills are put into it. So that to me is a flaw of the conventional model. But I think that might be, if that's assumed to be true, that might be a bit of where you're coming from, thinking that need, like that the need might decline. But I don't buy the premise of that at all.
Yeah, same. And the only other things I think that are worth in the last couple minutes here discussing potentially are everything else that centered on a rate of return. And they were mentioning 5, 4, 6% and how that's probably not worth it. And I think that just goes back to the very first thing we talked about, is this is best compared to a savings environment, where if we are going to discuss the rate of return, the internal rate of return of a policy, and let's lowball it and say 4%, that is still equivalent to 4% net of fees, net of management fees, net of taxes. So comparing a gross rate of return, adding all those things in, taking away the taxes that you're going to have to pay on it, is a very different metric. token is really not that far off when you compare savings versus the typical investment, although they are different and shouldn't really be in the same sentence.
And add to that two things. What is the economic value of certainty? Because we can't have our principal diminished by down years in the market, which throws off that entire average rate of return. I have a video on that. You can watch on our YouTube channel. The economic value of certainty. And two, the excess tax. How much does it cost you to not be able to touch that money? And so 8% a year that you can't touch for 3 decades, I want to cash flow that right now. And so it's a different way of thinking. It gets back to the network versus cash flow distinction, but the economic value of certainty and the access tax are two things that are never ever discussed, but are huge. And even though you can't just come up with a specific number and say this percentage of that rate of return is the access tax and this percent accounts for the economic value certainty lost in this case, you can't put those on a spreadsheet, but they need to be factored in.
Yeah, I think the next major comment was just talking about how we're going to go back to the Stone Age and everybody should be learning how to fix pre-computer cars. So I'll leave that for where it is. Since we talked about in the beginning, I happen to remain optimistic in a world of abundance and I don't want to live sheltered, imagining that someday I'm down with some of the prepper stuff. I definitely have made provisions for rough times, but I'm not going to plan on my life being just going from here to here for the rest of it. So we'll stop there. And yeah, I think that as far as talking about that, but the only other thing I did was I mentioned my level of premium, and some people I think didn't appreciate that.
That could be a fun discussion for another one. I think this is valuable because, again, these are challenges that people, like everyone has, apart from the funeral expenses, which it was a new one. All of these we talked through are questions we've talked through over and over. And so I think it's good to get this out here and set our response and put it on paper that we can refer people to. But yeah, we're about abundance here. You're only a victim if you choose to be. And so there's things outside of your control. You can't control the Federal Reserve and bank policy. That's going to happen regardless of your thoughts on the creature from Jekyll Island. Like, that's all happening totally independent of you. But what you can control is how do you most optimally steward your money right now and in the future. And we offer a really good solution for that.
Yeah, you're right, man. And I heard a quote, and I'm going to take it and change it a little bit from, I was talking to my son about this recently, but it was at the convention I was at. And I told him entitlement and victimhood are a loser's currency. And we're going to refuse to trade in those currencies. Man, good talk.
Yeah, that was good. I enjoyed that. That's fun to. It's much easier to talk through it and get ideas out there than typing away on a chat app, I think. So hopefully we address some of those concerns sufficiently. And again, in the same way that if you want to leave us emails, comments, or whatever, asking questions, we enjoy talking through this. We do it all day anyway, so we might as well record it and disseminate that information.
Yeah, cool. Anything else you want to, any last thoughts?
No, you'll be beardless next time I see you, which is just disappointing, but we'll manage.
It is. Someday when this beard becomes permanent, though, I'm afraid it's going to be all the same color as my chin. I do not want to wear it. All right, brother.
Cool, man. All right. I'll see you.